Interest rates stand as a fundamental cornerstone of modern monetary policy. They represent one of the most crucial instruments available to central banks worldwide. The primary purpose of these rates is to effectively manage and steer a nation's economy. At its core, an interest rate is simply the cost of borrowing money or the return on saving it. It is expressed as a percentage of the principal amount over a specific period. This seemingly simple concept holds immense power over economic activity. The influence of interest rates is broad and far-reaching, touching various aspects of economic life. They directly impact consumer spending decisions, making loans for homes or cars more or less attractive. Businesses also feel their effects, as borrowing costs influence investment in new projects and expansion. Ultimately, interest rates play a significant role in determining the overall trajectory of economic growth. Their movements can either stimulate or dampen economic momentum. Understanding how central banks manipulate these rates and the subsequent effects is vital for comprehending economic dynamics. This knowledge is essential for students of economics, finance, and anyone seeking to understand the forces shaping our financial world. It provides insight into the deliberate actions taken to maintain economic stability. The overarching objective of monetary policy is to achieve macroeconomic stability. This stability is crucial for a healthy and predictable economic environment. Central banks meticulously work towards this goal through the strategic manipulation of interest rates. There are several key macroeconomic objectives that central banks aim to achieve. One of the most prominent is controlling inflation, ensuring that prices remain stable and purchasing power is preserved. Unchecked inflation can erode savings and create economic uncertainty. Another critical goal is promoting full employment within the economy. By influencing economic activity, central banks can encourage job creation and reduce unemployment rates. A robust job market is a sign of a thriving economy. Fostering sustainable economic growth is also a core objective. This means encouraging expansion that is steady and long-lasting, avoiding boom and bust cycles. Interest rates are adjusted to support this balanced growth. Major central banks, such as the Federal Reserve in the United States and the European Central Bank, consistently utilize interest rates to pursue these vital goals. Their decisions are carefully weighed to balance competing objectives. These institutions act as guardians of economic health, using their tools to navigate complex financial landscapes. Their actions directly influence the economic well-being of millions. Central banks employ interest rates as a primary lever to manage economic fluctuations. Their approach differs significantly depending on whether the economy is overheating or slowing down. This responsiveness is key to maintaining stability. When an economy experiences high inflation, central banks typically respond by raising interest rates. This action is a deliberate attempt to cool down an overheated market. The goal is to reduce the amount of money circulating. Raising interest rates makes borrowing money significantly more expensive for everyone. This directly impacts businesses, discouraging them from taking out loans for expansion or new investments. Higher borrowing costs reduce their incentive to grow. Consumers also face higher costs for loans, such as mortgages, car loans, and credit card debt. This increased expense discourages them from taking on new debt or making large purchases. The overall effect is a reduction in consumer demand. The combined impact of reduced business investment and decreased consumer spending leads to a slowdown in economic activity. This cooling effect is precisely what central banks aim for during inflationary periods. By reducing demand, the pressure on prices eases. Ultimately, this strategy helps to curb inflation, bringing price increases back to a more manageable and stable level. It is a necessary, though sometimes unpopular, measure to protect the long-term health of the economy. Conversely, when an economy is sluggish or facing rising unemployment, central banks take the opposite approach. They will typically lower interest rates to stimulate economic activity. The aim is to inject momentum into the market. Lowering interest rates makes borrowing money much cheaper for both businesses and consumers. This reduced cost acts as a powerful incentive for economic engagement. It encourages greater financial activity. For businesses, cheaper loans mean it is more affordable to invest in new equipment, expand operations, or hire more staff. This increased investment can lead to greater productivity and innovation. It fuels business growth. Consumers also benefit from lower borrowing costs, making mortgages, car loans, and other forms of credit more accessible and affordable. This encourages them to spend more, boosting demand for goods and services. Increased spending is vital for economic recovery. The combined effect of increased business investment and consumer spending stimulates overall economic activity. This revitalization can lead to job creation and a reduction in unemployment rates. A stimulated economy generates more opportunities. This strategy aims to pull the economy out of a downturn, fostering growth and prosperity. It is a proactive measure to prevent prolonged periods of stagnation. The most common and direct interest rate controlled by central banks is known as the policy rate. This rate serves as the primary lever through which monetary policy is implemented. Its adjustments ripple throughout the entire financial system. A well-known example of a policy rate is the federal funds rate in the United States. This specific rate is set by the Federal Reserve. It is a critical benchmark for the nation's financial markets. The federal funds rate represents the target rate at which commercial banks lend their excess reserves to each other overnight. Banks use these overnight loans to meet their reserve requirements. It is a short-term, interbank lending rate. While the policy rate itself is an overnight rate between banks, its influence extends far beyond this narrow market. It acts as a foundational rate that impacts a wide array of other interest rates across the economy. For instance, changes in the policy rate directly affect mortgage rates, influencing the cost of homeownership. Corporate bond yields also respond, impacting how expensive it is for companies to raise capital. Even savings account rates, though often lagging, eventually adjust. Thus, by setting and adjusting this single policy rate, central banks can effectively guide the overall cost of money in the economy. This mechanism allows them to exert broad control over financial conditions. The impact of interest rate changes is rarely immediate or straightforward. Economic systems are complex, and various factors can influence how effectively and quickly these policy adjustments translate into real-world effects. Understanding these nuances is crucial. One significant factor is the existence of a lag between a policy decision and its full economic effect. It can take several months, or even over a year, for the full impact of an interest rate change to be felt across the economy. This delay makes monetary policy challenging. The effectiveness of interest rate changes is also heavily influenced by consumer confidence. If consumers are pessimistic about the future, even lower interest rates may not be enough to encourage them to spend or borrow. Fear can override financial incentives. Global economic conditions also play a substantial role. A country's economy is not isolated. International trade, capital flows, and global events can either amplify or dampen the intended effects of domestic interest rate adjustments. External factors are always at play. Furthermore, the level of government debt can influence the impact of interest rates. High government debt might limit a central bank's flexibility or make markets more sensitive to rate changes. Fiscal policy and monetary policy are interconnected. These factors highlight that monetary policy is not a simple cause and effect mechanism. Central banks must constantly monitor a multitude of indicators and anticipate potential challenges. Their decisions are made in a dynamic environment. Beyond the direct costs of borrowing, interest rates exert a profound influence on asset prices across various markets. This indirect effect is a significant channel through which monetary policy impacts wealth and investment decisions. It affects how assets are valued. When central banks lower interest rates, it generally makes borrowing cheaper and reduces the return on safe assets like government bonds. This often encourages investors to seek higher returns in riskier assets. Consequently, lower interest rates tend to boost stock prices. The real estate market also experiences significant effects from interest rate changes. Lower mortgage rates make homeownership more affordable, increasing demand for housing. This increased demand typically leads to higher real estate values. Conversely, when central banks raise interest rates, the opposite effects tend to occur. Higher borrowing costs can make it more expensive for companies to finance growth, potentially dampening corporate earnings. This can lead to a decline in stock prices. Similarly, higher mortgage rates reduce housing affordability, which can cool demand in the real estate market. This often results in a slowdown in price appreciation or even a decrease in property values. Asset markets react sensitively to these shifts. These movements in asset prices can create a wealth effect, where changes in perceived wealth influence consumer spending. A rising stock market or housing market can make people feel wealthier, encouraging more spending. In conclusion, interest rates are an exceptionally powerful and versatile tool in the hands of central banks. They are not merely numbers but critical levers used to steer the economy towards desired outcomes. Their role in monetary policy is indispensable. Central banks deploy these rates strategically to achieve macroeconomic stability and foster sustainable growth. Their primary aims include managing inflation, promoting full employment, and cultivating a healthy economic environment. These goals are interconnected and vital. However, monetary policy is inherently a delicate balancing act. Central bankers must constantly weigh the risks of inflation against the dangers of recession. Their decisions require foresight and a deep understanding of economic forces. The complexities of economic systems, including lags in policy transmission and the influence of external factors, demand careful monitoring. Strategic decision-making is paramount to navigate these challenges effectively. Understanding interest rates and their role in monetary policy is fundamental for anyone seeking to grasp the mechanics of modern economies. It illuminates how central banks work to maintain stability and prosperity for all.